There's an indicator that has predicted every US recession for the past 50 years. No exceptions, no false alarms. It's called the yield curve inversion. When short-term interest rates rise above long-term rates, when investors are more worried about today than the future, the economy is heading for collapse. 2001, yield curve inverted. Dot-com bubble burst. 2008, yield curve inverted. Lehman Brothers collapsed. 2020, yield curve inverted. COVID crisis hit. 2022, the yield curve inverted again. And for years, it stayed inverted. The gap widened, the signal intensified. But in early 2026, something changed. The inversion ended, the curve normalized. Short-term rates fell below long-term rates again. Most people celebrated, the danger is over. The economy is recovering. But experts know better. Because historically, the real crash doesn't happen during the inversion. It happens after the curve normalizes. When central banks panic and slash short-term rates to prevent collapse, that's when unemployment spikes. That's when companies fail. That's when the recession arrives. The yield curve just gave its final warning, and we're standing at the edge. The U.S. Treasury yield curve spread measures the difference between long-term and short-term government bond interest rates. This is a critical indicator related to economic activity and widely used for economic forecasting. Normally, long-term bond rates should be higher than short-term rates. This is the natural state when the economy is stable. But when rates invert, when short-term rates exceed long-term rates, it signals economic anxiety. Investors begin worrying about economic slowdown or recession. The inversion of U.S. Treasury long-term and short-term rates is interpreted as an important economic signal. Economists and investors watch its meaning carefully. History shows that when this phenomenon occurs, economic crises have followed. That's why market reactions are significant. Various factors determine long-term and short-term interest rates. Monetary policy, inflation expectations, economic growth rates. These factors are closely interconnected, forming complex relationships. For example, when central banks raise rates, short-term rates generally rise, but this narrows the gap with long-term rates, sometimes causing inversion. Understanding this mechanism requires comprehensive economic knowledge. First factor, investor concerns about economic slowdown. When confidence in economic growth declines, funds flow into stable assets like long-term government bonds. Long-term rates fall, while short-term rates remain elevated, narrowing or inverting the gap. Second factor, monetary policy. Central bank rate hikes are understood as measures to prevent economic overheating. Short-term rates rise, but if market concerns about rates intensify, long-term rates can fall further, causing yield curve inversion. Third factor, global economic correlation. We cannot ignore connections to the global economy. Economic instability and geopolitical risks in specific countries impact global financial markets. When demand for U.S. long-term bonds increases, long-term rates decline, potentially causing inversion with short-term rates. Examining these factors carefully is crucial. Understanding these facts comprehensively is important. Yield curve inversion contains meaning beyond simple numbers, so continuously analyzing correlations between elements is essential. The inversion phenomenon of the U.S. Treasury long-term and short-term rates affects not only financial markets, but the entire economy. However, the timing of this phenomenon and its economic results are complex issues. To understand this phenomenon, we must compare the conditions causing rate inversion and the resulting economic effects. The main cause of rate inversion is when short-term rates exceed long-term rates. This is generally associated with economic growth, slowdown, financial instability, and central bank monetary policy changes. For example, when rates are raised, short-term rates rise, but if the long-term economic outlook is negative, long-term rates decline. Rate inversion occurs in this process. When this phenomenon appears, economic impact mainly includes corporate investment contraction, consumer confidence decline, financial institution lending reduction. Conversely, when normal rates are maintained, economic activity continues, likely having positive effects on businesses and consumers. Why does the U.S. Treasury yield curve inversion receive great attention from investors? When rates invert, economic uncertainty increases, making investors fear it as a precursor to economic recession. In the market, 10-year Treasury rates reflect expectations about the future economy. But when people start worrying more about the immediate economy than the distant future, money flows into long-term bonds. Eventually, long-term rates fall below short-term rates, causing inversion. Historically, in the United States, after this phenomenon appears, recession inevitably follows after a certain period. That's why this indicator has always been called the economy's red light or early warning system. 2001, before the dot-com bubble burst, U.S. Treasury yield curve inverted. 2008, before Lehman Brothers bankruptcy, yield curve inversion occurred. 2020, before the COVID-19 outbreak, yield curve inversion occurred. 2022, yield curve inversion occurred again and the gap widened. An interesting change appeared entering early 2026. The inversion gap between 10-year and 2-year rates, which had persisted stubbornly for years, noticeably narrowed. The prevailing view in markets is that the inversion period has effectively ended. In some segments, positive transitions where long-term rates became higher have already been observed. Looking at numbers alone, we might think it's fortunate everything returned to normal. But experts say now is when the real test begins. Reviewing past cases, actual recessions often occurred not while rates were inverted, but during the process when inverted rates normalized. When central banks urgently start lowering short-term rates to prevent economic downturn, the yield curve steepens and normalizes. In other words, normalization itself can signal that recession has reached the threshold. Also, markets are holding their breath, watching whether the past pattern, where unemployment spiked right after the rate spread returned to positive, will repeat this time. Government debt and fiscal deficits are concerning. The reason long-term rates are high now might not be because the economy is good. It could be due to supply oversaturation, the government issuing too many bonds to spend money. Many interpret it this way. The resolution of yield curve inversion suggests we've passed one era's peak and entered a new phase. Rather than relaxing because numbers return to positive, we must more carefully examine what expressions real economy indicators, like unemployment or corporate performance, are showing behind the newly normalized curve. The first half of 2026 seems to require more careful observation than ever. By normalizing after years of inversion, the yield curve set a precedent. The danger signal isn't the inversion, it's what comes after. Central banks slash rates in panic. Unemployment begins climbing. Corporate earnings collapse. The recession economists feared during the inversion finally arrives, after normalization makes people think it's safe. The yield curve didn't lie, it never does. It just operates on a delay. 2001, 2008, 2020. The pattern never changes. Inversion warns. Normalization delivers. The curve just normalized in early 2026. The final warning has been issued. Most people think the yield curve inversion ending means the danger is over. Experts know the danger is just beginning, because historically, the crash doesn't happen during the inversion. It happens after, when rates normalize, when central banks panic, when unemployment spikes. If you want to see the signals that predict recessions before they arrive, not through headlines, but through bond markets, yield spreads, and patterns that have never failed, subscribe to Endgame Economics. Because by the time mainstream media announces the recession, your portfolio will already be underwater. See the warnings. Stay prepared. Stay ready.